Welcome to the Texas Real Estate Radio Network with Mr. Texas Real Estate Jason Bible and Mr. California Investor Robert Orfino. Join us as Jason and Robert talk about the hottest real estate market in the country, the entire state of Texas. Learn why Texas is such a great market to invest in and why it could be strong for years to come. Get ready to talk all things Texas on your new home on the way to the office. Texas Real Estate Radio.
Welcome to the show. We got a special guest in studio. We've had a lot of mortgage talk around here lately. So we brought in Jennifer Hernandez of Legacy Mutual Mortgage. And we're going to talk. I'm always like hesitant how to do a show like this. Do we talk in generalities, then we get really specific? But I think everybody likes the details, right?
Well, let's do the YouTube version.
Okay.
The truth about mortgages.
Yeah, there you go.
Yeah, I like that.
Yeah, the 10 lies your mortgage officer
Real
tells
facts,
you.
no BS.
Yeah.
You know that's kind of the tagline of my YouTube channel, Alone with Jen, right?
Yeah, I see it whenever you have a new one that comes
Real
up,
facts.
it pops up. So
Real facts, no BS, baby.
There you go.
So what is the YouTube? What's your YouTube channel name?
Alone with Jen.
Alone with Jen. That's right.
Yeah,
Okay.
and that's all my social media handles, Alone with Jen.
Alone with
and
Jen.
my website,
Yes,
Alone with
Alone
Jen.
Jen.
Branding. Very good.
Alone with Jen.
Yeah.
So what is going on in the mortgage world? We were chatting earlier before the show started that your world has got to be so insane right now. It is. What I'm reading from the national news is that purchases and refinances in just number of refis and purchases are at all-time highs, and the dollar volume is at all-time highs. So it's got to be pretty crazy at the office with the sheer amount of work you guys are doing.
Yes. So just to give people some perspective, the refinance market alone, and this has happened since COVID. So we all need to acknowledge that if COVID wasn't happening, rates would be in the fours. Like this is, yeah.
Mm-hmm.
So, February, in fact, it was right around my birthday. My birthday is in late February, and that was when all the stuff was going down. So I remember it clearly. And in the matter of a couple of days, the rates dropped like a percent, to the threes. And the number, $12 trillion worth of refis have potential to save money and make sense to refi. And there's only market and capacity and bandwidth, whether it's liquidity or staff or whatever, for $3 trillion. So we're behind $9 trillion. Well, a lot of people have already refinanced, right? So maybe the number's a little bit less, but the massive sheer numbers of if you are lucky enough to get in there. So I tell clients when they call me, I'm like, hey, if you want to refi, I'm going to give you the numbers and you have to scream super loud that you want me to pay attention to you, because on a daily basis, my purchases come first and I'm swamped with that. And on the refis, if you scream loud enough and text me enough times, I will pay attention and you'll get locked. But that's how it is with every single lender. It's sheer insanity. I've never in 25 years seen anything like it.
Yeah, if you're the person that's trying to rate shop 6 mortgage companies and all that, you're not going to get a refi done. They don't have time to play the games.
Oh, listen,
right?
I've had clients go, oh, hey, so-and-so is $500 cheaper in fees. I'm like, go for it. Kiss the carpet, take it. That's fantastic. Because, honestly, we're not going to lower our fees. I mean, we can't. It really takes every ounce. The margins are already super low. And if you're getting something lower somewhere else, then go get it. That's fantastic. Do it. So it's a tough time. It's a tough time.
Yeah.
Yeah.
And I had read,
a good tough.
Yeah.
Right?
No, it's great. I mean, it's been fantastic. Yeah.
So of the $12 trillion in possible mortgage business out there, the industry can handle about $3 trillion. I had read that for a healthy mortgage market, you only need about 4 million purchases and refinances in an entire year. I mean, it's not like people think you can just it's automatic, right? Like it's trading stocks. You can go out and, I can go out and buy a house while everybody else is going out and buying the house. And you don't understand that real estate agents are stressed because there's just so many people trying to buy houses right now. There's not enough inventory. If y'all have been watching, inventory is down 25 to 30% in most markets in Texas. And then you've got on top of that, you've got surveyors and appraisers and all that. Maybe you can talk a little about that. We're non-QM, so we've been having appraisal nightmares because all of you QM people keep stealing all our appraisals. So
well, it's I mean, for us, an appraisal is 3 weeks, and I had a transaction where I had 2 VIP clients on both the buy and the sell side. So I was super motivated for this thing to go smooth.
Mm-hmm.
And we just had to have a rush on this appraisal. Well, we didn't have to, but it would have been nice. Mm-hmm. And I think I got up to like $700 extra. I was like, look, I will give you money. Like, I got to get this done in like 8 days. He said, Jennifer, I would be stealing from you. No, I cannot rush this. Like, they can't. There's almost no rushes because they're inundated.
Yeah.
And so now what's happening is you make the appraisal order, and let's say it's due on the 25th. They literally will call the listing agent to make the appointment to go in like 3 days before. Like, they're just all running on fumes. I mean, appraisers are getting COVID. I mean, it's happening. And it's just sheer ginormous amounts of volume.
So what's fascinating to me is you mentioned that, appraisers are getting COVID, and it's like 99% of what people don't understand in the data is like, people are getting sick. They're not going to the hospital and dying, right? Most people, that's not happening, but they're getting this awful flu for a week.
Yeah, or even more.
Or even more.
They can't work.
They can't work. Then they have to quarantine.
Yeah, they got to quarantine. They feel terrible. And then they got to quarantine for another couple of weeks. So it's like...
So there's less appraisers. And I don't know. I mean, if anyone's looking for an industry to get into, go be an appraiser. Because honestly, a lot of like new, younger, people entering the workforce, right? They're not saying, oh, I'm going to go be an appraiser.
No.
So what's happening is a lot of these appraisers that have had great careers for 20, 30, 40 years, I mean, they're about to retire. Like, they're like, hey, I'm done with this.
It is an age.
And so then it's like, but it's so needed. So needed. So if you're out there looking for something, looking for a gig,
great,
call me because I'll put you in contact with an appraiser that has an apprentice program.
Yeah. So appraisers, inspectors, probably not so much. I mean, I don't know what the inspection business looks like these days. But
it's busy.
It's
I know. Gordon Fox is a good friend, and he's swamped.
He's swamped too. So what I want to at one of these segments here, I want to talk about what you could see improvement-wise in the mortgage industry. And I'll give you just one of the things that we're seeing. House affordability is dropping like a rock. So prices are going up. Mortgages have never been cheaper, right? I mean, just crazy how expensive they are. But the reality is that we're also not building new homes anywhere in the United States for, affordably anymore. So the question we keep bouncing around is, are we going to see a 40-year mortgage at some point? That's a Fannie Mae 40-year mortgage.
I don't know.
That I'm floating it out there, and we'll talk about it in one of the next segments. But how else do you make these things affordable? You can't build them anymore, so the government has to get in the building business, or they have to change the terms of the loan. Do you do a 10-year interest only with a 30-year? Because I've seen that in California a couple of times. Or do you just go with a straight 40-year?
Let's talk about that after the break. You bring up an interesting point.
How else do you make them cheaper? That's the only way to do it, because the rates are already in the basement,
PMI,
right?
Shipping containers. Right?
PMI, if they have PMI, you can make that cheaper.
That's true. That's true.
Hey, guys, thanks for joining us this evening. This is Robert and Jason with our good friend Jennifer Hernandez from Control Mortgage. Hey, give us a shout at 281-401-9008 and loanwithjen.com.
That's it.
Just always check that out, loanwithjen.com, before you start any of this process. Hey, we'll be right back. We have loan questions.
Oh, it's 4 million refis or purchases, Mario. I can pull it up.
You meant 4 trillion, right?
No, actual loans, not transactions, not volume.
You mean 4 million number of loans?
Yeah, number of loans.
Oh, okay.
Yeah, done in a year. 4 million in a year.
I was like, 4 million. That's like a drop in the bucket.
Oh yeah, 4 million. Yeah, 4 million. No, it's number of.
I do that every month. Yeah.
Yeah, it's number of customers. I can pull it up.
Yeah,
it's
3% of the housing market.
Yeah, 3. And it was. I was surprised. He's like, for a healthy market, it's about this. And then they started going through all the numbers. I'm like, I'll send you one of the best guys I'm reading right now is an analyst for Housing
Because
Wire.
I need to.
It's good.
Hey, and something. Well, as you were talking, it just got. I mean, some of the downsides of what's happening, like things are getting so sloppy, and even.
Let's talk about all that.
My brother-in-law is buying a new home.
Mm-hmm.
And the quality, like it looks nothing like the model that they
I'm
thought
sure.
they were. I mean, and what
Yeah.
do you do? So they went to go do the walkthrough, and they were like,
I got
"You
10
gotta be
people
kidding
right
me."
behind you. Yep.
Yeah, they're like we
the
don't care.
tradesmen are getting sloppy. Like
Yeah.
everything is really sloppy. It's really bad.
We got our new music.
A little bit.
Hey, good evening. Welcome back. This is Robert and Jason with Mr. Texas Real Estate, Texas Real Estate Radio Network. If you want to get a hold of us, check out our website at mrtxre.com. That's MR is in Mr. TX is in Texas, RE is in real estate, mrtxre.com. We're here with Jennifer Hernandez, loanwithjen.com. And we're talking, just in a break here, we're talking about the sort of downward pressure that everyone is feeling, right? Across the spectrum. So you were just talking about there's low inventory. And so the inventory that is on the market is sort of, you're going to take it as is or you're not going to take it, right?
Yeah.
And so we're seeing a lot of that. I know that I have a house. I sold all my properties up in New Jersey. They're all on the market. And I took the offer that said, I'll take it as is. I won't hit you up for any credits or any repairs and make this easy. And I can bring 20% cash. And I was like, done. Other 70 people that were looking at my house, I'm not interested in dealing with it. So we're seeing that in the marketplace all throughout the supply chain. We just talked about that in the last break. And so with a low inventory, and there's always a need to turn over real estate, you're going to see some of these issues. And so we're just talking about that.
So the new construction market is very interesting. So builder confidence is at an all-time high. As that shouldn't shock anybody, right? But they can't build affordable homes anymore. So how are Americans going to get into that affordable house? And so unless the government gets into home building, which God forbid, which they technically have in Section 8.
Many times, yeah.
And then they have done that from time to time. But do they start playing with the loan? So is it possible that we'll see a 40-year product, a 50-year product? I mean, because here's going to be the big question. The next housing crisis is not a crash. It's a lack of affordable housing. So how do you make houses less expensive?
Let's just think of the components. Principal and interest. Rates, can they even truly get any lower than they are now?
What's the difference between 0% and 3% at $200,000? $100 a month?
Yeah. And, but, property tax is
that's a big one in
component.
Texas. Yeah, big one in Texas.
And then homeowners insurance, which homeowners insurance I've seen and more areas around Houston are in flood zones.
It's a flood zone issue, and it's a cost of construction issue, right? The cost of reframing a house has gone up by an average of $20,000.
Mm-hmm.
Price of lumber is up 200%. So it's like.
So the only other component, because when you're talking about affordable housing, it's people that have PMI on their mortgage. So the only other thing that can be tweaked is private mortgage insurance. So right now on an FHA loan, it's a 1.75% funding fee that's put on top of it. So if you're borrowing $100,000, $1,750 is on top of that. So you're really borrowing $101,750. So that's part of their PMI, mortgage insurance premium. And then the other part is 0.85%. So you take 0.85% of the loan, divided by 12, and that's the monthly tacked on amount. So I can tell you in conventional loans, the better credit you have, the lower, like you can do 5% down and have PMI that's like 0.24%, which normally it's like 0.5. So having great credit is a benefit on a conventional loan, but on FHA, where a lot of people getting into homes that need flexibility, right? They allow lower credit, they allow higher debt to income ratio. They get these FHA loans, so maybe we'll see a reduction in the FHA premium. That could help out per month for sure.
I pulled a very interesting chart out, and it's from Logan, and I cannot pronounce Logan's last name over Housing Wire. And he's got this great graph, and it shows the number of mortgages per year by credit score. And since 2008, anywhere between 60 and almost 80% of the mortgages are 720 and above. Like, it's a huge, you can literally see it because it's a color-coded bar chart. And you could see where there was a pretty good mix before 2008. A lot of, some folks, even the low sixes, right?
Sub 650.
They would make up 40, maybe 30 to 40% of the marketplace, maybe 50. And then you get into this 720 and above, and it's literally almost 80% of the market. You can see the trend. It's amazing.
Mm-hmm.
So unless you have stellar credit, and that's, maybe I should say stellar, but at least top tier credit, you're not getting into a house. It's almost, if you look at total loans made, it's almost impossible.
Yeah. Can we talk about credit for a second?
Let's do it. Yeah.
So everybody is obsessed with their credit score, as they should be. Everyone should be worried about a lot of people are concerned about the well-being of their credit, which is fantastic. It's a fantastic trend. So do you want to know what super annoys me?
What's that?
That not all credit scores are created equal. So
That's
if
right.
I need to get a chess timer and record the number of minutes adding up to hours that I spend talking people off the ledge about credit, because they're like, oh yeah, I know my credit score. I have, ABC, credit monitoring service. There's so many of them. And 100% of the time, the credit score that they think that they have is not what we pull. I'm not saying that it's wrong. I'm just saying that it's different. So those of you listening, just the quick 101 is that there's over 25 models of credit.
Correct.
And if I'm a ABC company giving an online service, guess which one I'm going to subscribe to? The one that's the cheapest and the most generic, because I want to make more of the $8 I'm charging you. I want to make more of that money in my pocket. So I'm going to pay for the bare bone minimum, I'm giving you this free value. I'm your credit card and I'm making you feel this value every month. Like, ooh, punch this button and get your credit score. Okay, well, what does that mean? So the score that lenders pull is different. We all have to subscribe. 2, 4,
and 5, correct?
I have one of them is FACTA 8, but they're constantly changing because they're constantly being tweaked. So all lenders have to subscribe to the same one because that's how we can sell the loans between each other. There's conformity, right? So on credit, really, if you're doing a conventional loan, like FHA, your rate's the same pretty much no matter what. But there is some benefit if you're above a 700. If you're above 700 score FHA borrower, you actually get the very best rate. So there is a benefit. But on conventional, they really are good about taking incentives away, or I could say giving incentives for those higher credit scores. So 760 and above is really that top tier, and it goes in tiers of 20s. So 760, then you go to 740, then you go to 720, then you go to 700. And if you're below a 700, conventional is not great at all.
Yeah. In our mastermind, we tell our folks good credit starts at 740.
Oh, on investors for sure.
Yeah, you can tell me you have good credit, but if you're south of 740, you don't have good credit. You're just in that score that everyone sees on their website or on their credit card statement. We call that the FACO score.
Yeah, that's about right.
Score. It's a glamour score. It's to give you confidence to go out and use your credit card more.
Well, I mean, and it's not that it's fake. It's true to what that credit formula is doing, but it's just not the same. So we want to start by pulling people's credit, and the number one fastest way to better credit is how y'all utilize those credit cards, percent utilization per month. That's the number one thing that we see is the quickest way.
Just pay down the debt, right?
Yeah, just percent utilization.
Try not to run 3 businesses on your 4 credit cards.
That would help. that always helps. We're big fans of MyFICO because you can see all the scores. You can see everything.
I like MyFICO, and they have good education. The education tab has really good data. Yes, I like MyFICO as well.
And then you go in there and tweak stuff. We do this, we pay that off, we do that. We add a credit card, do a car. You can do all that. Run all the different, I forget what they call it, case studies or something like that on there. But yeah, MyFICO's it's the only one he and I use because otherwise you don't get a real score from just about anybody.
It's the closest to what we pull.
Yeah. Hey guys, Robert and Jason here with Jennifer from Legacy Mutual Mortgage, loanwithjen.com. Go check it out. We'll be right back from the break.
embarrassing.
We have a mix. I don't even know who that is. Oh, Stones. I think Rick slipped that one in.
Yeah.
I can't wait to see your new place. So when do y'all move in?
We're already
We're
in
working
there.
there now.
Yeah.
Okay, I'll have to come see you.
Yeah, it's pretty cool.
You pretty much go there every day, or I'll just text you one day and say,
We're
hey,
pretty much here every day now. It's about 2-3 weeks ago, we kind of moved in unofficially.
Nice.
So I think we're supposed to be open, October 1st, maybe?
Is that when the party is?
No.
No.
We're not. The party won't be until
December or so.
maybe.
Ready?
Yeah.
Okay.
Welcome back. Got Jennifer Hernandez, Legacy Mutual Mortgage here today, loanwithjen.com. And we were talking about mortgages. So I don't know how you solve the affordability issue unless you just turn them into 40-year mortgages or 50-year mortgages. It's the principle. That's really where.
Yeah, but then we're 2003 all over again, 2005.
Well, so that was the interesting thing is if the credit scores are still high enough, because I do believe that we've got folks who can't afford houses that have decent credit in, but then of course, like what margin, it's so fascinating. And I'd love your perspective on this. Seems very much different than 03 and 04 and 05. Like it's hard. It's still hard to get a mortgage.
I mean, not really.
I mean, if you're not a 700,
have a ton of debt, you have if you don't over indebt yourself,
okay, yeah,
and you don't spend more than you earn, and you maintain your credit and pay your stuff on time, you're fine. We have lots of clients that qualify just fine and buy within their means.
Yeah, but that's not everybody, Jen.
I mean, it's like.
Well, it needs to be about 37%.
I'll tell you what I'm seeing an uptick in, though.
What's that?
There are so many people that say, oh, yeah, now I'm driving DoorDash or now I'm driving Uber. And I'm like, okay, we need a 2-year history of that.
Right.
So after that, they'll be able to use this extra income. But a lot of, the revolution of all this extra picking, you can just pick up a shift by just, delivering DoorDash at night. Like
sure.
There's good money to be had. So the go-getters who want to change the situation are going out and doing that and saving their money. And it's definitely different than it was in 03 and 04. But there's still people could afford if they change some of their spending habits, they really could afford, more than they think.
Yeah. So what is we were talking about the cohorts here. We've got the millennial generation, the boomers. So the millennials are now starting to buy houses. And one of the things you and I talked about is student loan debt and the impact on being able to buy a single family home. So I would imagine you're seeing a lot more folks that have got a lot of student loan debt as opposed to kind of generations of the past.
Yeah, I pull on average about 70 credit reports a month. So we have a large spectrum. We see more and more people that are not high trade, that are just bachelor degree, they're not doctors and they're at least $80,000 in student loan debt.
That's crazy.
And it is, I remember thinking back to a student. Back then, I paid my way 100% through school, and you couldn't do that now. Like, you can't wait tables 3 hours a week. That's what I did. I worked at Bennigan's on Texas Avenue in College Station.
I pumped gas and changed oil.
Between a little bit of student loans and working, waiting tables, working for tips, working all the football games when the parents came into town, that got me through. But you can't do that anymore. And so you're right. The affordability index of everything is higher. And we see a lot of student loan debt, and it is Fannie Mae and Freddie Mac and FHA don't see eye to eye on how they actually, FHA, the government loan, actually kind of sticks it to you a little bit with student loan debt, which is surprising because they make us take 1% of the balance to qualify. So if you have $100,000, that's $1,000 a month added to your debt to income ratio. You're not going anywhere.
Yeah.
And so then we've got to help you get your credit up so you can qualify for a decent conventional loan. But then the debt to income ratio requirement is lower. You know, FHA is fantastic. You can go up to a 55% debt to income ratio. So there are things in place for affordability, but then the rules don't match each other. So it's really it's very conflicting. You know, FHA this, conventional that, swapping between the two of them. Credit requirements are different. Rates are different. So maybe there could be more conformity between qualifying to make it more affordable. So a lot of people with high student loan debt don't have great credit scores.
Interesting.
So then we got to take the 1% rule, and then they really don't qualify.
Yeah.
So we're like, yeah, sorry, you can't buy a house right now.
As the houses become more and more and more expensive.
Yeah.
It's a fascinating quandary to watch, because you see these folks that got out of school with, like you said, $70,000, $80,000, $100,000 in debt, who are not doctors and lawyers and all that other stuff.
They're just regular, and they're never going to be able to pay that off ever.
Right. Yes.
So what they do is they get on the IDR, income-driven repayment, which FHA won't recognize. Okay, so if we're counting $1,000 towards the payment because it's 1%, right? The IDR is $100. We can't acknowledge that to qualify you, which is super unfair, if you ask me. And then, so there's all these people around the country on IDR, income-driven repayment, right? That's super low based on what their affordability to pay it back is. And it's just not ever going to be paid off. And they're banking on the fact that somewhere, somehow in the government, it's all going to be forgiven.
Yeah.
Yes.
And they'll let them go to collection. I've had people, they let them go into collection, and they're like, yeah, I mean, you definitely can't get a loan when your student loans are in collection. I mean, you can't, like, you can't get another federal debt, like an FHA loan, if your current federal debt is delinquent.
Yeah, it makes sense.
Yeah. But if you do pay on time for 6 months, they'll take it out of collection, and it'll go back into the good section of the credit report. Yeah. So I mean, there's workarounds, but the bottom line is, oh my God, there's so many forks in the road. I could be here for hours.
Well, one of the things that's fascinating is if you do not buy a single family house, and I'm not one that thinks that a single family house that you live in is an asset, but the reality is it can be if you manage your household right.
Sure.
And what we're finding is there's going to be an entire generation that, you know, where these folks that went to school, have a okay job, but not enough to really pay down that student loan debt, that are going to be unable to buy a single family house, and they're going to be the first generation that is negative net wealth.
Well, that's that's right now.
Yeah, that is absolutely happening. Yeah.
We're in it. And so, you know, the credit scoring model needs to change. We keep hearing that it's going to change, but if you have one collection and it was even $10, it doesn't matter what it's for, your credit score goes down like 80 to 100 points.
Oh, yeah.
Oh, I will tell you right now, when I sold my companies, I don't know what happened, but there was a utility bill that didn't get paid.
Yeah, it was probably like $100.
It was like $130,
yeah.
And we ran my report. All of a sudden, it's in collections. I'm like, you have got to be kidding me. And we are still fighting it right now.
And so even medical collections, any of it. And so it's the system is flawed, and there's just it's too overwhelming.
So you're in better shape if you don't go to college, become a manager at Home Depot, or run a dock somewhere, run a forklift, and you're $20 an hour.
Well, that's a little extreme. I think it's you don't go to college and incur a bunch of debt. If you're
you can't get through college.
Well, so here's the all right. Well, so here's what we're doing in my household. You're not going to college unless you're going through STEM, because otherwise, I don't see mathematically how it works out. Like if you're just going to college for like general business and it's $100,000, how are you going to make that back unless you're going to a top tier school or you're in an engineering program or a math program or something? I don't know how college is. Otherwise, it's community college. because the math just doesn't work.
Mm-hmm.
And I would love for somebody to show me math that does work, that says $100,000, education and a liberal arts degree is going to work out. I just don't see it.
Mm-mm.
No, not at all. Hey, this is Robert and Jason with Mr. Texas Real Estate. This is Texas Real Estate Radio Network, here with our friend Jennifer Hernandez from Legacy Mutual Mortgage, loanwithjen.com. We'll be back. But what I always thought about this part of the country, this Midwest, is you could be a manager at Home Depot who makes $45,000 a year. Your wife could just have a regular old, be the receptionist at the vet, right?
Yeah.
It makes $28,000. Between the both of you are close to $70,000. But you have no debt, and you can afford a $190,000 condo somewhere.
Yeah. Or not even, the condo, depending on the HOA fee.
Sure, just a small house in Wichita Falls, Texas, right?
Well, but
$190,000.
these days, we've got clients that they just qualify for 150, 160, and they're like, but I can't get a house that's
right.
in a decent place where I want to live for that amount.
Right.
A lot of flood zone houses.
Mm-hmm. Oh, that's true.
Well,
yeah.
They're not living in the McMansion. They're not getting that 4-bedroom, 2-bath, 1,800 square feet.
But they're getting an appreciating asset, though.
Yeah, that's what they just understood. You could
120 or
could
150
move up.
doesn't matter. Yeah.
Hey, we're back. We're talking about the struggles of the youth here these days.
Well, if I were to go back way back in my day when I bought my first house, 2003, that was exactly why I bought that house. I'm like, well, it was new construction, and bought one of the first houses built in that neighborhood, but I bought it for like $128,000. Yeah, $128,000, 1,800 square feet, 4-2. Lived there for 12, 13 years. But the first thing I recognize is you got to buy something because you're going to be chasing your tail in affordability.
Yes.
Like I shouldn't say chasing it. You're never going to catch it. It's probably a good way to put it. So for those of you who are first-time home buyers out there and like, well, the neighborhood I want to send my future kids to starts at $250. I can only afford $165. I'm like, guess what? You're buying in that $165 neighborhood because, like you said earlier, you need that appreciation.
But hurry up! You have to do.
You got to do it right now. I can see that. Let me put it this way: all the stuff that we predicted 18 months ago is happening. Like the appreciation curve is steepening, meaning it's getting more expensive faster. The year-over-year appreciation in Houston at the median is already 11%.
Well, so I'm using with clients, I just use 3%. I say, look, let's take a worst case scenario, 3%. And you buy a house that's $200,000. That's $6,000 a year. Is rent doing that for you? No. So you need to hurry. Like, oh, let me wait next year until the real estate values are coming down. I'm like, in a house under $300,000, they're not coming down.
No.
And we have a client that went out this weekend and the realtor told me that the client automatically, the house is maybe 220, 230. And they said, oh, okay, yeah, we're going to offer 190.
No,
and it's like, wait, where are you getting your data? Like what rock are you living under that you're not, it's going to be a waste of time. You're not going to get any offers. You're not going to get anything accepted.
You know what I would do with those clients? And I would show them, the HAR report comes out every month, right?
Mm-hmm.
And there's that table that's in the middle of the page, and it shows year-over-year median home price increases, and it's 11%. So it's like, look, you can wait. This house is going to cost you 11% more next year. Now, maybe it's not 11%, maybe it's 5%, but it also could be 15%. Like, you just sitting around waiting, you are literally being blown out. Like, these things are appreciating so fast. We have a broker as a partner of ours in one of our businesses. And he had one of his agents listed a house out in Katy, south of I-10. I cannot remember the neighborhood. Older neighborhood. They listed it for $225, $260, whatever it was. Very close to median home price. Yep. He was like, hey, guys, how many showings do you think we had? Rob was like, I don't know, 30. I was like, 35 to 25, something like that. He said, we had 100.
In how many days?
Like 5 days or something, 4 days or something
Through
ridiculous.
the first weekend,
And he
That's
said,
amazing.
we had 20 offers, half were cash. So if folks are sitting around like, oh, well, maybe, we're kind of looking, it's like, you don't understand. Like, what you're going to see over the next couple of years is how fast that median home price catches the average price. Well, you can actually see the curve already. And the average price is $330 335, I think, 3 something.
Yep.
Somebody can pull it up and post it on
335.
335. So if we're at 260, it's gonna hit 335, and I bet in less 18
At
months.
least 300.
Wow.
I mean, it's just 12% year-over-year growth. That's the entire marketplace. But we know all the action is at the median home price and below, at least at the average home price and below.
Mm-hmm.
So let's turn this a little bit. So we spent most of this hour talking about pitfalls and what's happening and all that stuff. And now we've underlined the point to buy the house. Who is getting the mortgages and who's getting good mortgages?
Well, define a good mortgage.
I don't know.
A mortgage
3%.
is a mortgage.
Yeah.
So.
Oh, you know what? Tell us the difference between 3% and 3.5%, because that's always good for me. It's like $25 for every quarter point. What's the difference in payments?
You mean 3% of?
Because everyone's hunting these rates, and you've just explained in the very first segment, you can hunt all you want. I'm processing, right?
Yeah. So the difference. The interest rates between 3 and 3.5%. It depends on the loan amount, of course.
Sure, 300,000 is the average household.
Yeah, 300,000. I'd have to break out my calculator.
Don't do that. But
it's probably $50 a month,
right.
50, 60.
People are wasting time, losing thousands of dollars a month over $50 a month.
Yeah.
That's crazy. So who's your avatar? Who's your perfect client?
Oh, I just help my perfect client is someone who gets me the paperwork that I need.
That's what I was going to say. Someone who listens and does what you need to as soon as possible.
Someone who follows instructions.
Yes.
And they don't sit on the doc request for 5 to 6 days.
Yep.
And someone who has a sense of urgency.
Yeah.
So, and that, we do a good job. We could always do better at training them in the very beginning.
Sure.
Because if they're not going to be that way, that just go somewhere else.
Right.
This is the way it works. So, and it starts with how we're referred. So I'm only referral. I don't advertise.
Great.
Because I just don't.
We
Other
stop
than
everything.
you're the only channel that I advertise with. And the clients that call me from you, by the way, they're always super directed. They're always great. They're always like, yep, tell me what to do. Just, they're always fantastic. But for the most part, I don't advertise. Okay.
Mm-hmm.
And really for me, from you, it's like a warm referral because they all love you guys. And they're like, oh yeah.
We appreciate the support. Yeah. We love referring people to you. You do really good.
Well, thank you. So really, I help anybody, honestly. Some of my most favorable and memorable and rewarding transactions have been, we just helped a 100% disabled vet, and they're like in their 60s, and this was their first house, and they were like not thinking they could ever get a house, and they got a VA loan. They literally had like $50 out of pocket.
Oh, wow.
The seller was a builder who was so gracious, covered all their closing costs. I don't know what we did. We just made it happen. And it was it was difficult. It was a struggle, but they did everything we asked them to do. That's my typical client. You know that the paperwork is needed. You don't, you can ask questions. I'm not saying not.
Yeah.
Sure, no, of course, yeah.
Like, listen, it's painful for me too to ask you for stuff. Just know that you have to get it. Like, that's it. And if you can't, then don't and go rent and then come back when you can get it. It's just as simple as that.
Yeah.
And so that really is my typical client. But I'll tell you, I do see a lot of people struggling with credit, especially, people get behind. I'm still seeing some people that were affected by Harvey, but that's now 3 years away. So it's getting a little bit better. So anything on your credit that's within the last 2 years is the most, it taints your score the most. So we still see people that are struggling, especially, and I think it's the tip of the iceberg because of, some people are getting laid off and they just can't pay. So I don't know what next year is going to bring, but my ideal client is just one that just
sends the paperwork.
Give me the docs.
We've walked out of the studio before because we got loans going on. Get out, go do it, right?
Yeah. So that's my best client. But I see a lot of people between 680 and 750. There's a lot of people in that range with credit. So I'd say, get with a lender early to see what your credit is. Get on a plan. Get the GPS for what you need to do, and you might have to wait a year. I'm really good at telling people, look, you have to wait a year. And they're like, what? And I'm like, just go rent. You got to wait a year.
Mm.
It's going to fly by super quick. Do these things. So if people are giving you advice, take it to heed and do it. And then drive DoorDash if you have to pay the bills. I mean, seriously, like do what you got to do.
One of our favorite things, become a real estate agent in our EXP team. If you're a real estate investor, because that's a great way to build a little side business. It's a good way to get into real estate investing without spending a bunch of money. So, all right, when we get back from the break, we'll talk more with Jennifer Hernandez at Legacy Mutual Mortgage.
That was 4.
Oh, you give me the hand signals. I'm like, what's going on? All right, that's the 4th one. All right.
How often do y'all do the show? Once a week?
It's a daily show, but we'll shoot like we'll do this. We did this one with you, then Rob and I will do another hour. And then we're so far ahead on shows. We did 2 with Alex last week that'll play the next couple of days. We used to do 2 hours of radio a day. Now we're down to 1. It's a lot. And then our best of show up in New York and California on Friday and Saturday.
Do all these circle their way around to the California stuff?
Yep.
Mm-hmm. Yeah.
So, are y'all doing a lot of business out of state? Well, I guess California.
Well, we were about to really start doing a lot of business until Corona. We were going to be in Cali at least once a month and in Jersey.
Yeah.
Literally he and I would just be flying back and forth. And we were going to build our mastermind group in California, have another one in Jersey and New York, and just all that literally got shut down.
You're virtual.
We are,
been,
but it's different. Better to do it in person.
Yeah. You got to build relationships.
Yeah. We're still signing up 3 to 5 folks a month for our mastermind group, which is pretty good.
Yeah, it's really good.
So it's working out. It's just we'd like to get back on, stage and the in-person meetings and all. And our meetings are never 100 people in a room. Usually they're not. It's 15, 20 people. Yeah. So we qualify them pretty quick on the front end. But yeah, it would be.
Yes, we do. Don't show up if you're broke.
Yeah, we have this thing. we have this thing on the show where it's like if you don't have 40 to 50 grand to invest and you don't have a 700 plus credit score and at least $100,000 a year job, like we're not a good fit. We can't help you. Right?
Well, and that's the thing is that's what we really try to do up front, super quick, because I do an intro call with everybody, and in that 5 minutes, I can disqualify people super quick. Because I just say, hey, what does Credit Karma say that your score is? And if they tell me anything below like 600, I'm like, okay, go get it fixed.
Yeah.
Then come to me. Oh, but so-and-so said you could really help me fix my credit. I said, no.
That's not my service, yeah.
Go call credit. Here's 3 names. Go call one of them. Come see me really filtering through the people that, are a fit.
It's unfortunate. And I think the irony is that education is they spend all that money on education and they didn't learn basic finances and how the mortgage system works.
Well, and let me tell you, a lot of, and not even millennials now it's going to be the kids like my teenagers age, whatever they're called, the Gen Z or whatever.
And their Z's, yeah.
They don't know how to mail an envelope. They don't even know what a stamp is. They're like, how do you mail? What? Where do I get a stamp?
I didn't realize. Yeah, I didn't realize until I gave my son a phone that he did not know how to answer the phone.
Yes.
I called him and I'm like, "Hello," and he's like, "Dad." I said, "You don't know how to answer the phone, do you?" Like I didn't. This is when he was 12. I'm like,
these are basic skills that we need to remember to teach them. Like they're getting a whole different education than we were.
Yes.
And so what happens is that floods over into their expectation of what they know and what they don't know when they're buying a house.
Yeah.
And now there's so much information on the internet, like so much, that's why I'm like, real facts, no BS. I'm trying to, on my site, just filter, here's the real facts.
Yeah.
I'm going to help you compile hours of research that you would go online and you can Google a term and then be like, which of the 100 entries
is the right one?
Click on? Yeah. So it's too much. It's
one of the things we've said is there's lots of information but no wisdom. So what they're really looking for is where's the real authority here, and it's all, it's kind of all over the place. So
yeah.
So we'll have our studio in our building.
Fun.
And we'll be doing the shows at noon.
Fun.
Monday through Friday, and then